Now we're going to turn to the ISM manufacturing, which came out today. And if you remember, my view was that manufacturing was going to stay in expansion and it was going to remain there. I wasn't expecting a big increase in the movement, but here you can see that August ISM manufacturing came in at 52.8 versus the estimate of 51.9. So again, you had a nice bump. And so I was expecting to kind of hang out at that 51 and a half. But here, you had a nice little bump. And one of the positives, or I should say several of the positives, new orders moved from negative 48, contraction to 51.3. Nice move. And employment went from 49.9 to 54.2, another nice acceleration. So again, those are two strong things. And then prices paid went from 60 to 52.5. So still expanding, but at a slower rate. Now, one of the things that we do expect prices paid, remember, again, to accelerate a bit, still remain in expansion. But the new orders one is the one that we want to watch the most because it had a nice acceleration. It's back to expansion, but is this a makeup? Is there new orders that were coming through for Christmas? So it's going to be important to look at, is this a flash in the pan and then the downside continues, or are we seeing a bigger trend change? Now, looking at the regional data, I would say right now, this is more of a pause than it is a change in trajectory, but it's still a positive. And we want to see if manufacturing came in strong, where are services? Because one of the things that we were expecting is that manufacturing was going to stay in expansion, services was going to remain in contraction, and then that'll negate, depending on how far down services is, either to fairly flat to slightly down. But again, these are the things of why, as much as I want to say, they were wrong to say Q2 wasn't the beginning of the recession, it wasn't. And this is where we sit when you look at some of the key pieces. It's where are we going to go from here? So now in the next part, we're going to go through some of the regional pieces and why we think this is a bit more of a spike and then a fade and a little bit of a slowdown back, still in expansion, but still back closer towards that 51. And where we see things going from there. So the regional business activity indexes, again, that's looking at the four. So this is a chart that it keeps adding as the regional data comes out. 4 Fed districts come in with negative 7.5. National, manufacturing PMI came in at 52.8. So you're like, all right, well, you're still a little bit of that disconnect. So where does that follow through? But then when you look at the new orders, so again, the 4 Fed districts are at negative 17.7, and the national manufacturing PMI new orders had a bounce. So this is a bit old. It shows 48. It was actually obviously an expansion. So is it the regional that is wrong, or was there a pause? And if you look, before we had that second drop in August, you had an actual increase, but the national had a decline. So is this regional data that we saw now showing up in the national, and then we're going to continue? And based on what we're seeing, I'm going to say yes. But again, it's important to say, I don't think that we're going to get this huge drop off where new export orders and new orders are going to go from 52 to 42. It's again going to kind of hang in between that 40, slight contraction, 48, 49, slight expansion. And that's where we're kind of waffling back and forth, which is why we're just holding steady at the moment, because we haven't really had that big pivot down from the consumer. Merchant wholesaler inventories was expected to be up 1.4%. Instead, it came in at 0.8. But then when you look at the restocking, you look at the inventory to sales ratio. So even though inventories came in a little bit lighter than expected, when you look at inventory to sales, you're still at the upside because sales are slowing. Again, some of that balancing that we're seeing between new orders and sales. Now, I should say new orders and the consumer. So then real consumption of all goods ex autos is down, and import volumes will follow that piece because, again, inventories are up. People aren't spending as much, sales to inventory ratio. So the real consumption of all goods, the actual consumption, not again, this is the value versus volume piece. The volume has dipped, which again is that overhang. Nominal personal consumption. Now, this is the nominal. So we know the real dipped, but nominal consumption was expected at 0.5, came in at 0.1. Real personal consumption was expected at 0.4, came in at 0.2. So then when you look at that going forward, nominal disposable personal income up by just 0.2% in July's slowest gain since January 2022 when income contracted. So you're getting some of those mixed signals, but again, we still see that downward trajectory. Once you start factoring in where is personal income, where are those flows coming through? And again, there's that underlying piece. Consumer confidence index rose in August to 103.2 versus the estimate of 98. And as we were saying, usually gasoline is a big driver in this. And so as gasoline prices have gotten better, consumer confidence was going to get that bump, but you can still see it only carries so much because of the other ancillary pieces and headwinds that continue to exist in the market. And with that being, like what continues to exist? Well, consumer confidence index present situation rose to 145.4, while expectations climbed to 75.1. So expectations climb, but the spread between them is still now at negative 70.3. So they're still really deep when you look at where they are at the moment. So it's natural things don't continue to go to hell in a handbasket. People adjust the way they feel. Obviously gasoline helped. Some of the other ancillary things help, but we're still on that downward pressure. And that's where, when you look at expectations, we continue to see that overhang. Significant slowdown in Kansas City Fed. Manufacturing index came in at 3 versus the estimate of 10. But again, it was positive, slower, but positive. New orders fell deeper into contraction at negative 16. Shipments contracted to negative 13. Production fell to negative 9. Employment slid, but still expanding. So that's where some of it's good. The employment was good. It slid, it fell, but still positive. But the other pieces have continued their downward move, which is why when we look at manufacturing, we still see some of that overhang. And this is just putting it into perspective on what pulled it down when you look at some of those underlying pieces and the problems in general. So then when we look at Dallas, manufacturing index came in at negative 12.9 versus the estimate of 22.6. So again, down, but a bounce. And you're seeing that. So you're still in contraction, but you're, again, not terrible. New orders and outlook ticked up, but are still contracting. Production moved lower along with shipments and employment, but still expanding. So again, you're that mix. It's still negative overall, but not as bad, which is, again, showing up in that ISM manufacturing. But is it a bounce and a fade as we go through September? And my belief is yes. It will be that bounce coming into August. You had back to school. You had things starting up for the ordering that's going to happen for Christmas. And then I do think you get that slowdown that's going to continue. Dallas Fed manufacturing capacity utilization, negative 0.6, contraction, expected production, a bounce, but you can see it's still well off of what is normal, but still, again, you're getting some of those mixed signals still on the weaker side, but better. Prices paid came in at 34.4. Prices received came in at 26.8. Again, you can see the rate of change is starting to turn, and that's something that we think continues through this period. As expected, prices paid has fallen, which is a positive because that's what they're expecting. But if you look at wages and where wages are and the expectations there, it's going to have to be some of this balancing act. But as we showed in segment 1, prices have gotten better for shipping. And that's, again, some of that offset, which is helping move this a bit lower. So regional Fed surveys for this week, Richmond Fed, when you look at it in blue, came in at negative 8. Kansas City came in at 3, but you can see, again, the trend is still down. So it underscored continued slowdown at headline level, only formers in contraction territory. But again, that deceleration has been fast. It's been swift. So again, that's where we think that's going to continue to move lower. Now, when we shift over to housing, again, some of those mixed signals here, home price growth finally easing, 18.6% year on year versus the estimate of 19.2. Overall, U.S. National Home Price Index came in at 18% versus 19.9. So slowing, but still high. And you get an idea of, again, where that stickiness is remaining for the consumer. So here, when we look at it, expectations of healthier housing market continues to implode from both builders and consumer perspectives. University of Michigan expectations for increase in home value and future sales component are in free fall. So again, nobody is expecting so National Association of Home Builders future sales through the floor, and then expected values during the next year, again, falling. So people are looking at this and saying they don't expect home prices to appreciate, and home builders are expecting sales to slow. So again, you're seeing some of those underlying headwinds, and the Google searches for sell my house have increased. And it's always interesting to see, people trying to see, did I miss the top? And I think that's more along the lines of, well, is it still late? Should I do it now? And the answer is you missed the boat. And again, you either got it or you didn't. And if maybe you were on the earlier side of that cycle, hopefully if you were looking to sell, you were able to sell and get something at least reasonably priced. Because even if you were selling at a high, you're also buying at a high. So could you offset that? And so this is, I think, an interesting one when you look at Google searches. And then the annual change in median rent, obviously below where it was in 2021, but still high. I mean, we're not seeing rents collapse. And it's going to take a lot of this new construction coming online to help offset that. New listings of homes down 15.4% year on year. Redfin Home Buyer Demand Index at about negative 12% year on year. So again, you're getting new listings coming down. Demand is flatlining a bit, and again, nothing goes down in a straight line. So it's a matter of that mixing between, but with the slowdown in buying, well, before the pandemic, and this is looking at rents, average rent in the U.S. It was about $1,623. Moved up to $1,828, and now a year later is $2,031. This is sticky. And that's what we've been talking about when we look at sticky inflation. This is the pain when we're looking at it. You're going to pay that $2,000 plus, typically not month on month, but for the year. So that's that. If you look at, that's almost $400 more than pre-pandemic that you're paying. But inflation is going up. So you're not only paying that here, you're paying it at the pump, you're paying it in the store, at food. So again, you can see the compounding impact and how this isn't going away quickly. U.S. Mortgage Purchase Index continues to fall and is at its lowest since the pandemic. So again, you're just seeing mortgages slowing down and showing, again, more of those cracks in terms of future buying. Percentage of home sellers switching listings to rental due to rising mortgage rates. So again, there's people who are saying, okay, well, instead of selling my home, I'm just going to rent it. Like I'm not going to get what I want, but rents have gone up. So why not capture the rent while I'm waiting for the housing market to recover? And I think you're going to see more of that, which will also help bring rents down. So again, as people pivot, and that's going to be the important thing, because it's not all at once. It's not just one driver. There's multiple drivers that are really mixed within that. Mortgage rates have been moving in a wider range of late, but average 30-year spike higher this past week. And again, rates continue to be up, which is going to keep those pressures if you look at just underlying housing. Housing market shifting. It takes 23 days to sell a house today. Again, still low, but you can see the pivot has shifted, and we expect that to continue to accelerate. Now, when we look at U.S. consumer confidence indicator, starting to adjust, but again, it's not that it's adjusting much back up. There's a certain amount of how continuously can we go down before people are like, okay, well, it's not that bad. And then something happens and it's like, oh no, it's really bad again. And gasoline was as we said, was going to be that driver of some of those benefits. Now, when you look at revision for August, sentiment broad index up to 58.2 versus 55. Expectations component rose to 58 versus 54.9. Inflation expectations fell from 5% to 4.8%, and then looking to about 2.9%. So when you look at it, people are still concerned, but as we said, like it was too much too fast. Gasoline was going to be the positive, and here is that playing out as well. Before we talked about consumer confidence using the conference board. This is University of Michigan. But then when you look at consumer sentiment, you're getting an idea of what some of the drivers are and how buying conditions are still very low. Current personal finances are still low. And that's, again, weighing on those expectations, which is going to keep spending capped, going to keep things slow. And we do think accelerate to the downside as we progress through September. So that's what we have for you for rounding up the U.S. And in the next segment, we're going to go deeper into Europe and some of the new data sets there.